Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how you navigate a fixed rate expiry or your interest-only term expiring, particularly related to investors. I guess the interest only is, and fixed rates. It's been very well documented, that what do they call it? The fixed rate expiry cliff that is happening this year and even a little bit into next year. That is a whole bunch of Australians that fix their interest rates during 2020 and 2021. Those interest rates are expiring and might go from 2 to 6%, for example. And that's going to have a pretty big impact on consumer spending, which I've spoken about previously, but I don't think it's going to cause too many problems in terms of defaults and arrears and all those sorts of things. In fact, it's estimated that there's $478 billion of fixed rate loans that are expiring this year. That's a huge amount. And of course, interest-only terms are another one. A lot of people set up their investment loan with interest-only repayments, and I'll talk about why that is the case in a second, but obviously that's a change that people need to navigate as well. And what I wanted to do is just during this episode to talk through how we deal with these sorts of matters for our clients. Okay, so let's talk about your options firstly, both for interest only and for fixed versus variable. So if your fixed rate's maturing, of course you've got two options. You can refix for another term, or you can roll over onto a variable rate. And so when we compare fixed and variable rates at the moment, for home loans, fixed rates are about 1% more than the current variable rate. And for investment loans, about 0.8% more than the variable rate. So really you're paying a premium, a much higher interest rate, so they don't really look that attractive, particularly if you think or agree that we're very close to the top of the interest rate cycle. So why would you pay a premium for interest rate protection? In fact, you're probably just going to be worse off as a result of that. When you have a look at forward rates, so what we look for there is what bond rates are doing over 2, 3, 5, 7, 10 years, etc. It gives us an idea of what the market is pricing in terms of interest rate increases, and then therefore how likely is it that we're going to get a good deal from a fixed rate perspective on a mortgage basis? Because obviously what the bank can borrow at, they then add their margin on top of that, and then that's what's going to sort of drive, the fixed rates that are available on the day. Well, when you look at forward interest rates, they are slightly lower than what they currently are today in terms of variable rates, but not material. So it's not surprising then that fixed rates just aren't attractive. But what could happen in the future, 6, 12 months time or whatever, again, depending on what happens with economic data and what the market thinks interest rates might do in the future, if the yield curve starts to invert, so if it looks like those forward rates, 2, 3, 4, 5 year forward rates are actually lower than the variable rate, well then that's when you might start seeing more attractive fixed rates. So just typically, until that happens, we recommend clients just switch over to a variable interest rate, probably hang there for a while, and let's see what happens over the next year or two with respect to fixed rates, and they might start to become more attractive, particularly if the market starts really aggressively pricing in interest rate reductions. I'm not suggesting that will happen, but it could happen, and if it does, obviously fixed rates might become more attractive then. Okay, so there are your options for a fixed rate expiry. What about a interest-only term? So if you're coming towards the end of your interest-only term, what are your options? Well, firstly, let's explain the structure, a mortgage structure. So typically in Australia, a mortgage term is 30 years. And you can then decide how you want to repay over that 30 years. So if you have a interest-only loan, typically the way that's structured is the first 5 years is interest-only, and the remaining 25 of the full 30-year term is then principal and interest. Now, if you get to the end of that first initial interest-only term, you can apply for another interest-only term, but that then means the remaining mortgage period is only 20 years. So you've got a lot shorter period in order to repay that loan, or at least from the bank's perspective, when they assess whether you're able to repay the loan, the assessment is going to be over a much shorter period, which can be challenging from a borrowing capacity perspective, particularly given they're testing, your capacity to repay at a very high interest rate. They're adding 3% above what current interest rates are, so they're in the 8s or 9%. Which is pretty unrealistic, really. Now, the bank doesn't have to give you another interest-only term. Of course, you're contracted to make principal repayments at a particular stage, so you can apply, but they don't have to provide another interest-only term just because you've requested one. Okay, so when deciding whether to continue with interest-only, there's really two factors that you need to consider, and two competing factors, if you like. The first one is that interest-only, or setting your loan up as interest-only, gives you more flexibility around what you want to do with your cash flow. So you can divert cash flow then into the offset account and actually repay debt, that's fine. Or you can decide, no, I want to divert my cash flow somewhere else, whether it's repaying other debt, such as your home loan, non-deductible debt, making super contributions, just building cash buffers, whatever it might be. It gives you more flexibility around cash flow because it sets your monthly repayment amount to the lowest amount. So that's the pro. The con with an interest-only loan is interest rates. Interest-only loans attract higher interest rates, and that's because back in 2017, the banking regulator, APRA, decided that there's way too many interest-only loans being made, and they wanted the banks to reduce the proportion of new interest-only loans being made. At the time it was 40%, it's much lower today. So that means from an investment perspective, you pay an extra 0.25% in terms of interest rate if you compare an investment loan on interest-only or P&I basis, and more than 0.5% if it's a home loan. The banks really don't like home loan debt on interest-only anymore. So they're the two considerations. Do you want flexibility with the cash flow? And if so, are you happy to pay the premium? Or are you just going to put your surplus cash flow into debt reduction anyway, in which case then maybe go for a lower interest rate? Now, when navigating or contemplating these changes, both fixed rates, fixed versus variable, and interest-only versus P&I typically encourage clients, and certainly this is the approach we use for our clients, instead of reviewing loans on an individual basis, I would much rather review a client situation on a portfolio basis, because I think that helps really inform us about what is the right decision for that particular client at that particular time. Now, there's lots of considerations that you might want to take into account. I've just listed a few, which I'll reel off now. But if I'm going to sit down and review a mortgage portfolio, these are the sorts of things that I like to consider when navigating those potential changes. The first one is, will your borrowing capacity change? So that's really, is there a change in employment or income or financial situation that will either improve or impair your borrowing capacity in the future? And if so, that might dictate when you make changes to your mortgage rather than, when these periods expire. It might be, when your situation is changing. So that is, you might need to do it sooner, or you might need to delay it for a little bit of time. Do you expect to buy or sell property? So particularly if you expect to sell property, then you might want to structure your loans that are going to give you the most amount of control of the sale funds when you eventually sell it. That's particularly avoiding cross-securitization. If you plan to buy, then you want to make sure that you've got ready access to a deposit. And the lender that you choose to use or choose to continue to use has sufficient borrowing capacity to allow you to make that purchase. Next one, buffers. Financial buffers. Do you have enough financial buffers in place just to navigate any sort of unexpected changes or unforeseen expenses? So I think having really strong buffers in place reduces risk as an investor. The next consideration is loan-to-value ratio. So what is the most optimal loan-to-value ratio for your situation? Sometimes we don't want to give the bank any more security than they absolutely need, although the other consideration is trying to keep the LVR around about 70%. because that gives you the best pricing power, so lowest interest rate or highest interest rate discount, putting it differently, but without giving the bank too much security. The next consideration is really how much access to equity do you have? So if you've got a whole bunch of equity in the property, do you want to just get access to that, even if you might not have any particular or immediate plans on using those funds? So I'm one of those investors that likes to do that. If I've got a property with a bank and the LVR is only 50%, I'll go and create a second loan and increase the total LVR to 80%, giving me access to 30% of the property value. And I'll just let the money sit in the offset account or redraw, whatever the case may be. Even if I have no particular plans on using the funds, you just never know what's around the corner. And I think having access to equity makes really good sense. Can you consolidate your loan accounts and clean up your structure? So if you've got multiple loans that relate to one investment, can you consolidate those? Can you then just secure those loans by the actual property that it relates to, rather than, maybe 10 years ago you used your home as security for a deposit facility and so forth. Maybe you can clean that up. Obviously, still making sure things are structured correctly and not having cross-securitization in the portfolio is important. But the fewer accounts that you have and the cleaner the structure is, the easier it is to maintain your record keeping and therefore protect your interest deductions. Put yourself in the strongest position to prove to the ATO, should you ever need to, that the interest deductions you've claimed are in fact correct. Another consideration could be bank valuations. Is your lender habitually undervaluing your property? Different lenders will use different valuers, and sometimes those valuations can change or vary significantly. So if you've always had problems with your lender, maybe it's time to switch. Does your lender's policy and product still suit your circumstances? So, for example, you might have started using your existing lender 10 years ago when you're an employee, and today you're self-employed. It's quite possible that maybe their policies just don't suit you anymore, and they're not the right lender to use. And it's a little bit like trying to put a square peg in a round hole. It can be quite frustrating. So that's particularly the case if you've been at your lender for a while and or you've had some significant circumstantial changes more recently. And the final consideration I can think of is, do you plan to help children in the future? So that is, kids get into the property market, and if that's the case and you want to use something like a family guarantee, then you want to make sure that the lender that you use is able to provide that and is in fact good to deal with in that situation. Of course, there could be a whole heap of other considerations that you need to take into account. Of course, these are going to vary from a client-to-client basis, but that gives you, a good sense or a flavour on how, we take a sort of very holistic approach where reviewing loan structure, that all these considerations might actually help inform us on what to do with the particular loan that we're thinking about. Okay, so let's talk about the practicalities of doing this then. The first one is, when do you start? When do you start needing to think about this? I would say, unless you expect your circumstances to change, I would say somewhere between 2 and 3 months in advance of your interest only or fixed rate term expiring. No point starting before then because, a lot can change in a very short space of time in the mortgage market. And you want to start 2-3 months just in case you do need to refinance to a new lender. You can give yourself enough time in order to complete that refinance. Now, of course, if your circumstances are changing, well, you might need to start addressing that change either sooner or later. Okay, so there's a few steps involved in navigating or dealing with these changes. The first one is you need to research your options, of course. So if your fixed rate is expiring, you want to make sure that the variable rate that your loan's going to roll to is going to be competitive. If your loan was set up, 1 or 2 years ago, it's actually likely that your interest rate discount would be out of date. That is, lenders are offering much higher discounts today than they were 2 years ago. So your mortgage broker can do that research and make sure that do enough research to compare different lenders and make sure ultimately that the lender you're with is going to offer you that competitive variable rate. If it's an interest-only term, your broker's going to have to consider whether you actually do have the option of rolling over to a new interest-only term with your existing lender. It's quite possible that you might have to, in fact, refinance to a new bank. Typically, most banks are happy to extend an interest-only period only once. So that's 2 5-year periods. But once the borrowers utilise those 2 periods, then they typically require you to start paying principal and interest, in which case then, in order to get a new interest-only term, you've got to refinance to a new lender. So obviously your mortgage broker, or if you've got a banker, they can help you decide what your options are in that regard. And of course, if you want to contemplate a refinance, you need to make sure that you've got the right borrowing capacity and you meet all the credit criteria and so forth. So that's in fact another consideration beyond that. But it's really research your options, work out, do you stick with your existing lender? Is that possible, or do you need to refinance? The second option is once you've done that research, and you might be able to do these 2 steps at once, but it's really about speaking to your existing lender and making sure that they're going to match the best deal. So if you've worked out that in fact another lender is going to give you another interest-only term, or a much higher interest rate discount, then it's always good to go back to your existing lender and give them the chance to retain your business, because the mortgage market is pretty competitive. Now, if your existing lender isn't going to come to the party, the next step you need to do is submit, or ask your mortgage broker to submit, a discharge authority to that lender. A discharge authority is really just a form, a 1 or 2 page form that formalises the refinance process. And what you do is you fill out that form and you send it to your existing lender, and your existing lender then knows to expect a phone call in the next couple of weeks from the new lender to try and book in a refinance. But the point is of submitting this form before you even go to a new lender is that it sends a very clear message to your existing lender that you're just about to go. Now, and what that will do sometimes is trigger an additional retention step by that lender. So they sometimes wait until they get the discharge authority before they actually offer the deal that they're really happy to give you. And there's no point you going through a whole refinance, whole new application process with a new lender if your existing lender is just going to come to the party at the 11th hour. In our business, we'd rather find that out sooner rather than later, to save us the time and hassle of doing the work, to save the client the time and hassle of going through an application process, and ultimately get the best deal at the end of the day. Now, if you submit that discharge authority and you don't hear from your existing lender within 2 or 3 weeks, well, then you definitely know you've explored every opportunity to avoid needing to refinance. And if the saving or structure is superior, then you know that it's well worth you refinancing. Okay, so there you go. That gives you a good summary of the approach that we take internally when navigating these sorts of loan changes and advising clients. Hopefully that gives you a bit of an insight on what to consider and then how to approach those changes. Okay, that's it for this week. Until next week, bye for now.